treat this as an actual conference. Attend as many sessions as you can, engage with our speakers, visit our exhibitors, and network with friends and colleagues. We have a terrific conference platform and have tried to schedule enough breaks so that you can decide whether to check in with your family, get some work done, or engage in the optional small group discussions and sector meetups. If you miss a session, no worries, no problem. It is recorded, so you can go back and watch it later. Before we begin, I'd like to thank our chairs, Carolyn Evans from Intel, Catherine Mann from Citi, Mark Pallen from Fannie Mae, and their excellent committee pulling together this outstanding program. I also want to thank NABE's roundtable chairs who planned many of the sessions, and the NABE staff, of course, who will be working behind the scenes this week to make this event run smoothly. We also have to thank our sponsors, and in particular, the Peterson Foundation, McKinsey Global Institute, Haber Analytics, KPMG, CoreLogic, For Credit, Grant Thornton, Morning Consult, NFIB, REMI, Census, the Upjohn Institute, General Motors, Macro Policy Perspectives, and Oxford Economics. Without the support of our sponsors, this event would not be possible. And please, do visit their virtual exhibit booths. Exhibitors have scheduled demos and talks from their experts. You can click on the booths to check the schedule of activities each day. And without any further delay, away we go. I will pass the baton to Diane Swonk of Grant Thornton to moderate our first session. Diane, you take it from here. Thank you.
Thank you, Manuel. It's my true pleasure and honor to be able to introduce Tom Barkin, president of the Richmond Fed. Tom has done some great speeches that I've all read recently, and Tom has just been traveling around his area. He's been highlighting and spotlighting some of the inequalities that we see out there. Tom is a voting member of the FOMC this year, so clearly important in his views. And also important to remember that Tom came from McKinsey. He's background with Harvard, both an MBA and undergraduate from Harvard, and also was on the board of directors at the Atlanta Fed. Tom, I will turn it over to you, and then we'll see how many questions we can get you to ask and how much I can pin you down. I know some of these, I've watched your interviews lately, and you're very good at not completely giving me all the numbers that we want, and that might be your job today, but we're going to try.
Well, that sounds like fun. Thank you, Diane, and thank you for having me here. I just reflect and say it's been quite a year. Had I been with you a year ago, we'd have been in the midst of an unprecedented economic shutdown. Equity markets had just dropped 30%. Bond markets were in trouble. Investment grade credits were struggling to roll over their commercial paper. 700,000 people lost their jobs last March, and then another 20 million in April. Our economy was on the edge of a cliff, and no one knew what was on the other side. Fiscal and monetary policy responded with overwhelming force. The Fed stepped up early and powerfully. We took our policy rates to zero in mid-March and worked to repair financial markets through our balance sheet, purchasing 1.7 trillion of treasuries and mortgage-backed securities in March and April alone. We also relaunched a number of Great Recession-era emergency lending programs that backstop specific bond markets. Congress acted decisively as well. Through multiple fiscal packages, it supported those who lost their jobs, as well as small businesses and industries at risk. To put the magnitude of this fiscal response in perspective, the nearly $4 trillion in federal relief spending during 2020 is more than 4 times the size of the 2009 American Recovery and Investment Act. And of course, another $2 trillion is on the way. With this support, the economy has come most of the way back. GDP was down 2.4% in the fourth quarter compared to a year ago, and our recovery has outpaced the rest of the world, with the exception of Asia. Despite 9.5 million job losses, the impact of policy on the economy is quite visible. Aggregate disposable income has gone up, not down. Households have increased their savings. Households have paid down their credit cards. Bank portfolios have remained healthy given all the support to individuals and businesses. The housing market has been strong, in part due to low interest rates. Increased savings have fueled a shift in spending from services to goods, and that's helped manufacturers. And the worse off have benefited from stimulus checks enhanced unemployment benefits, and forbearance. Now, that said, spending has come back faster than employment. Until recently, job losses on a percentage basis exceeded those seen at the depths of the Great Recession. The economy still has 6.2% fewer jobs than in February 2020. Still, I'm hopeful that we're at the brink of completing this recovery. Vaccines are rolling out. Case rates and hospitalizations are falling. Excess savings and fiscal stimulus should help fund pent-up demand from consumers freed by vaccines and warmer weather. So as we look toward better days, I want to talk about the potential for scarring. And hopefully these comments will set the tone for my friend Byron, who's talking about this right afterwards. Before I say more, the views I express are my own and not necessarily those of any of my colleagues on the Federal Open Market Committee or in the Federal Reserve System. So let's talk about scarring. As my audience here knows well, labor economists have something very specific in mind when they use that term. They're typically assessing how workers are persistently impacted by a downturn. For example, those who graduate in a recession may start work at lower wages than cohorts who start their careers in expansion, depressing their earnings for years. Those who lose their jobs during a recession can struggle to get rehired after a lengthy period of unemployment. The idea of hysteresis is related to scarring. It proposes that temporary shocks can have permanent effects on economic growth. But it can be hard to see the lasting impacts of demand shocks when looking at the economy as a whole. One of the Richmond Fed's economists has documented that in a recent paper. He and his co-author find no evidence of permanent damage to US GDP from demand shocks over the last 60 years. Still, I believe that severe downturns can leave scars that, while not always permanent, take a long time to heal. After the Great Recession, regions that saw the biggest drop in housing prices saw employment remaining at 2009 trough levels as late as 2018, and only recovering because unemployed workers moved to seek opportunities elsewhere. Similarly, the decline in manufacturing employment during the 2000s also resulted in a long period of elevated market detachment for less educated prime-age workers, particularly in the Rust Belt. While we did ultimately build toward a robust labor market, it took a decade after the Great Recession ended to get there. Now, this time, we've seen a sharper drop, but also a quicker recovery. And perhaps we'll see less damage from long-term unemployment than during the Great Recession. Job losses this time have also been heavily concentrated in high turnover occupations, like housekeepers and waiters. And even before COVID-19, these workers changed jobs regularly. Workers displaced in these jobs may be able to more quickly transition to jobs in similar industries, spending less time out of the labor market. The increase in teleworking could also improve matching between workers and jobs relative to what we saw in the last recession. Instead of becoming isolated in towns with few opportunities, job seekers might be able to find new employment elsewhere, provided, of course, they have the right skills and reliable broadband. Now, despite these positives, I still worry we're going to see scarring, but I think this scarring will be in new places. COVID-19 has hit primary caregivers particularly hard. School and child care closures put pressure on parents. The data suggests that this pressure initially fell disproportionately on women. Despite some recovery, labor force participation for parents remains about 6 percentage points below where it was prior to the pandemic. And if parents who left the workforce don't return, that would have long-term negative implications for our growth potential. Speaking of schools, we also face potentially huge losses in human capital from the shift to remote education. The Richmond Fed has launched a 6-part series on this topic, which you might want to view. We know from decades of research that learning builds on itself, and that means that disruptions to schooling are likely to have lifelong consequences. In the 5th district, students outside of the suburbs are less likely to have access to computers and fast broadband at home, and this greatly impedes their ability to learn remotely. Students in low-income neighborhoods are more likely to suffer persistent negative effects from the shifts to remote learning, further widening the education gap that existed before the pandemic. The pandemic has also accelerated automation, boosting demand for contactless technology, online retail, and telemedicine. As a result, we could see less demand for the low-skill personal contact jobs that today have higher unemployment. A recent paper suggests that women may also be more exposed to this risk than men. On the business side, this recession, like most, hits small businesses hardest. Larger businesses generally have had the resources to navigate the pandemic. With fewer small businesses, we risk missing out on the game-changing productivity gains that they often deliver. If you take an even broader view of scarring, the pandemic has placed a unique strain on cities. Many people who used to work in downtown offices are home. City residents are afraid to get into crowded subways and elevators. City amenities like theaters are closed. History has shown us that cities are incredibly resilient, having survived countless wars and plagues, so they might well recover. But there are already signs of migration from downtowns to surrounding suburbs in the largest cities. If this shifts commerce from downtown to the suburbs, what will that mean for the many service sector businesses and workers in city centers? We risk scarring our urban platforms of collaboration and innovation. And this pandemic has also strained our country's finances. On the policy side, the aggressive fiscal response helped support a quicker recovery, but it's also fueled a record increase in federal debt, over $4 trillion last year. While there are no immediate signs of a US debt crisis, we should be wary of diminishing our fiscal capacity to respond aggressively to the next crisis. Europe's overall fiscal response to the current crisis has generally been smaller than the US's, and one could argue that has held their economies back. So what can policy do? The first and obvious step is to get the virus under control. Scarring of workers, businesses, and communities should be much less in a world that's able to return to normal or something resembling normal quickly versus one in which we're still afraid to get into an elevator. The priority now is getting vaccines distributed and safely reopening the economy. It's also well worth exploring targeted support for workers affected by this crisis, paying special attention to programs that allow primary caregivers to return to work. These include support for childcare, elder care, and safely reopening schools. In addition, the large number of displaced personal contact service workers need help transition new occupations. States can open up licensing and add instructors for in-demand occupations like nursing or commercial trucking. Funding from Pell Grants, state lotteries could be freed for community college certificate programs. More broadly, we have to invest further in education. We've heard from educators throughout our district that students are falling behind because of remote learning. And while schools are starting to reopen, many parents remain fearful of sending their children back. This is especially true for families of color who have been so disproportionately harmed by this pandemic. Many students will need extra instruction and tutoring. Schools need the resources to safely teach in person so that parents feel confident allowing their kids to return. Perhaps they need to find a way to leverage this summer to catch students up. On the business side, we will undoubtedly see sectors shrink and sectors grow. That's natural. Now, on the other side of the pandemic, the objective may be less around support and more about letting market forces work. Preventing scarring may require taking special care not to hinder the creation of the companies of tomorrow while trying to protect the companies of today. As someone focused on the rural-urban divide for years, I might call out that small towns and inner cities face one common challenge: the lack of affordable broadband. This crisis has crystallized the case for its universal deployment, and doing so may be the greatest lever for revitalizing the residential part of inner cities and making small towns competitive in the pursuit of jobs and talent. Our bank has made this a research area of focus as well. As I discussed at the beginning, fiscal support has been critical to getting us on the path to recovery. Once the economy hits stable footing again, it will be important to take steps to get our fiscal house in order so that we have the capacity to limit scarring the next time we have a downturn. With the crisis behind us, we need to find the political will to bring our deficits to sustainable levels. At the moment, the US still seems to have fiscal capacity, but that's always the case until it isn't. The Fed is trying to do its part to limit scarring as well through a new long-term policy framework. In our Fed Listen sessions, we heard from countless people who let us know the least fortunate benefited from the historically strong labor market in 2019. We hope to support bringing in more people from the sidelines by maintaining accommodative monetary policy so long as inflation stays moderated. To close, I would just reiterate, we're seeing scarring from this downturn, and we will see scarring from this downturn as always. But we have in our control the ability to limit the unique damage of this one, and I hope we will. Thanks, and Diane, now I guess I'll open it up to questions.
Thank you so much, Tom. Of course, you're singing to the choir, singing to me about scarring in the labor market. That is something I've been very concerned about, and especially you highlighting the issues of broadband and that need for both rural and urban broadband distribution. Really important. I really appreciate what you guys have been doing at the Fed in terms of dealing with inequality, which I may ask you about later, but I promised I'd give you some other questions first. And I want to start with our NABE survey came out today in terms of the policy survey. And over 70% of NABE participants were really concerned about climate change. And I know that the Fed is concerned about climate change and how it affects our financial stability and our financial system. Senator Pat Toomey of Pennsylvania has penned a letter to Chairman Powell about climate change and how he doesn't feel the Fed, and I quote, lacks the jurisdiction over and expertise in environmental matters to actually regulate or do the stress tests that other countries are doing with regard to climate change. How will this pushback affect the Fed's efforts to deal with the threats created by climate change, which is clearly amongst our membership, but also how will you put it into effect in dealing with stressing bank balance sheets?
Well, let me start by saying I agree with the NABE membership that climate change is a critical issue. I also agree, I think, with at least the spirit of Senator Toomey's note, which is that the core responsibility for doing something about climate change rests with Congress, rests with the executive branch. And I, for one, hope that we will do a lot to do something about that. I'll just speak for myself here. You know, at the Fed, the focus is on the mandate we have and the tools we have. I do think a very relevant spot for climate is in understanding and manage against the risks that climate change could bring for bank balance sheets. So I think that is a legitimate place for the Fed to focus. And just as an example, I'll talk about concentration risk. That's an important issue in my district, which includes the beaches of South and North Carolina. When we talk to banks, if you talk to banks that have significant exposure and beachfront property in South Carolina, we might ask questions about concentration risk. And if one were to think that hurricane exposure might increase, then that risk only increases. And so I think there is a role for us to play. It's in the zone that's within our charter. And I do think things like concentration risk are the perfect place to start.
Thank you. I really appreciate that. You know, one of the questions that came in, I'm going to sprinkle it in with all those lists that I also sent you, but in light of potential labor force scarring, the Fed's focus on a more inclusive labor recovery, which I got to give you guys a lot of credit. I was at some of those Fed Listens events and they were truly remarkable. Will the FOMC move away from forecasting the U3? This gets into something about the dot plots, you know, and we can talk about those a little bit too, but instead of doing that, doing something a more broader measure, whether it be U6 or an employment to population ratio, will the Fed sort of shift away? Is that a way to maybe even improve the forecast in terms of what the Fed's trying to communicate about its goals?
Well, I think going back to the early 2010s, you know, Janet in particular did a really good job, I think, of putting on the table the question of a broad range of indicators of labor market functioning. U3, U6, you know, whatever your preference is. I'm personally quite taken by employment to population, especially prime age. I think it really does make the point. And, you know, this downturn makes it clearest, right? I mean, how many people, parents are a great example I mentioned, have left the workforce. And so you can look at the unemployment rate, 6.2%, and say, all right, we've come a long way back from where we were. Or you can look at the number of people, the fewer number of people employed, and say, holy cow, until February, we still had a higher percent out of work than we did at the depths of the Great Recession. And so I do think, at least for me, I look at the broader metric, and I think unemployment is part of it. You want to know who's looking for work and can't find it. But I think in the environment that we've just been through, you've got to think more broadly. And again, I personally like employment to population.
We're hearing that a lot in the Fed talk as well. And so I appreciate that, because I think it is really important. And you really underscored why. You noted about parents, you know, coming back in and how disproportionately this has hit parents. Well, we know in the next few months, there's going to be these base effects that happen because a year ago at this time, prices decelerated. And so year-on-year measures of prices are going to go up. We know that. And the Fed should absolutely look through that, because that was in relation to a crisis a year ago. I'm not sure bond markets still understand all that, but I'm right there with you. And I tend to side with you more in terms of I think inflation will be transitory, but there are many who don't believe that. Now we're looking at unleashing this pent-up demand that you remarked about in your comments. and the shift moving perhaps out of goods into services. Maybe we'll see a rotation in that. But with that, there's likely to be some flare in inflation, everything from the algorithms on airfares to hotel rooms, obviously. And sure, there will be a flare in inflation. And I was walking down the travel aisle. I took a picture. It was a rare time outside of my house over the last year. And I took a picture of the travel sizes. They put a whole aisle to travel sized items because people are traveling again in the local pharmacy. But I mean, I was quite stunned by that. So, from your perspective, what is considered, I know you don't like to answer this because the Fed we'll see it we'll know it when we see it, but can you give us any kind of a benchmark of what's a flare in inflation that would be transitory? Is it 5%? Is it 3 months? Or can't you put numbers on that? You'll just know it when you see it. What can you tell us? It's my job to try to nail you down. I know it's hard.
Sure.
But...
So let's just talk about the spring and summer this year. We are already seeing from these fiscal stimulus checks, and the folks that I talk to who are running retailers, they're already telling me, especially retailers that sell low to moderate income products, that starting this week, things just started flying off the shelves. And I think that is the impact of these stimulus checks, together with the rollout of vaccines and warmer weather and pent-up demand and excess savings, and all of the things that are going to propel, I think, a very strong spring and summer. Your point on base effects is very real. I would just remind everybody that we saw the opposite of it in the summer last year. I think it was July, August, and September. You had core PCE reads in the 0.4 kind of range month over month for 3 months in a row. And so we're going to have 3 deflationary months coming. We're also going to have 3 inflationary months coming. And so I think the classic measure, which is the 12-month trailing PCE, you just got to look through that for the next 6 months. I just don't think there's any,
just whatever the number is, just
any good way to hit that. What I'm trying to watch are 2 things. One is the month over month. I feel very different if I'm seeing 0.2s and 0.3s on the core PCE versus if I'm saying 0.6s and 0.7s, just to pick up various numbers. But I think you can look at that, and that'll help you with the base effects. The other thing is, where is it happening? And so, I absolutely expect car rental prices to go up. I mean, of course they will. Airline prices. And so if what you're saying is inflation that's driven by a recovery and those sorts of things, that's very different than if you're seeing it in rent or healthcare or some of these, big items as part of the index that you might worry would have longer term stability. And so I don't think there's a better way to do it than you just try to take the index. And you know this, but if you take the 170 elements of the index and you pile them up from high to low every month, you'll see, massive variations. Let's see where the middle of the index, trim mean is another good way to look at it, where those things go. That's, I think, the best way to look at it.
Well, I think you just gave us a little more information than we had, so I appreciate that, Tom. And
just for context, I tried to get a rental car in Tampa for this coming weekend, and the prices were $300. Now, wow. I don't for one day. Now, I don't think that's because that's actually the price of rental cars. I think they're actually out of rental cars.
Yeah, no, that's I know. The used car prices, as we get into just the spring months, they're already double digit above a year ago because we've run out of used cars. And then as we get into March and April, they could be 30% or more above a year ago because of what happened a year ago, because they don't have rental cars.
We know we've got shortages in construction materials. We know we've got retail goods that are stacked out in boats outside of Long Beach. So we know we've got those supply shortages. And I just think you have to look through the stuff that looks temporal and try to look at things that looks longer term.
I appreciate that. You issued that. That's one side of it, is the flare in inflation due to the recovery. And you don't want to, what I'm hearing you say is, I don't want to get in the way of what's a transitory shock and stop a recovery from being more full, especially when it comes to employment, because employment lags. And you really eloquently went over the scarring effects, and I can really relate and appreciate those comments. Another question, on CNBC on Friday, you echoed Chairman Powell's commitment to be patient in raising rates. And there's clearly a division within, I guess, either the communication or our forecast within our own membership. About half our membership thinks that the Fed will be raising rates in 2022. The other half is 2023 or later. That's very different from the Fed's own forecasts, although, there's I think some things we should know about those forecasts that we need to take into account. And I'll let you answer what you think about that in terms of, how do we deal with this communication issue and what kind of, the overshoot we're talking about. To get there, you got to get into 2022, right? Or is it, and then you'll know whether or not the flare in inflation is there or not. Give me some context on that second part of the Fed's inflation shift, which I think is a paradigm shift to overshoot, to get it to 2%. It's average inflation targeting, but I think it is a paradigm shift for the bond market because they've been riding these, inflation down. They don't care as much about disinflation as you do.
So on rates, we have given, I think, extremely explicit forward guidance that is outcome based. And then, I'm certainly in the world of trying to resist, like I hope my colleagues are, any effort to turn that outcome based into calendar based,
Right.
Because it is outcome based forward guidance. And I think, when do you do outcome based guidance is when the future is highly uncertain, right? And I can't imagine a future more highly uncertain than the one we've been through and the one I think we're continuing, as this inflation discussion we just had, would suggest. So it's a very uncertain world. We have outcome-based guidance that's quite explicit, the 3-part test. The SEP forecasts, I think everyone knows this, but I'll just say it one more time with feeling.
Yeah,
I really quite like it because it forces me once a quarter to tie my instincts into numbers in a way that I think is really quite disciplining for me in terms of thinking about the future. It then ties my preferred policy path back to those numbers. I think if you look through those forecasts, what you'll see is there is a range of people's forecasts about what's going to happen with the economy. And that range in forecasting is leading to a range in the time of liftoff against our forward outcome guidance. It's not a difference in guidance, it's a difference in forecast. And so maybe that's true of your members too. Some of the members think we're actually going to see a much more robust 2022, that inflation is going to be more permanent, more long lasting. You're not going to have a bounce back in inflation. Others might see it differently. And so I think we'll know better as we get closer, what the economy is actually doing. And then that will help ground the timing better than what we've got. But, when you look at that SEP in this environment, you're not looking at a rate forecast, you're looking at an economic forecast. And that economic forecast is what's driving the rate forecast as opposed to the other way around.
Unfortunately, I think that's misunderstood, but I'm glad that you're homing down the point because it's really important. I'm also looking at some questions coming in, and this relates to the issues. And I know you've thought a lot about some of these issues. One of them is, how do you assess the impact of COVID-19 on productivity? Now, we know what I think you can probably tell us what it did, but what do you think about it means going forward? Because there's a lot of uncertainty on that range too. And there's my dog barking. This is what it's like working from home.
It's always a risk when your last name is Barkin that somebody brings a dog into the conversation.
And my dog's name is Bear, but it's he came with that name, so it's nothing bearish on the markets or anything.
So look, I think it's almost impossible to know what's actually happened to productivity over the last 6 months and the next 6 months. And I think that's true for a lot of obvious reasons. The virus has hit hard the lowest productivity sector of the economy. And so, you have a bunch of people out of work in restaurants. That makes the reported numbers look better. Now they're going to come back to work. How's that going to look? I think governmental restrictions have imposed productivity limitations in a bunch of different businesses. Think of the NCAA tournament with the 3,000 fans or whatever they were running, yet they're all the stuff they have to do to get ready for it. And you've got a bunch of investments in things like automation that obviously ought to improve productivity over time and hopefully will. By the way, you could argue each of us working from home is somewhat more productive. On the other hand, there are research that suggests that over time that productivity increase decays because you don't have the opportunity for collaboration and the like. So I don't have any good guidance on productivity. I do have I do have a sense, though, that the businesses I talk to have taken the opportunity of this crisis, even if they haven't been hit, to dig in and work on what's the next evolution of productivity. And so I think when it settles, you will see somewhat more productivity. I think we've moved business, think of online shopping, toward higher productivity sectors. Telemedicine would be another one. So my instinct is that we're going to see productivity on the back end of this, but I don't think at this point there's anything I can point you to in the numbers that would validate that.
Appreciate that. There's an interesting question coming in, and it is International Women's Month, and I do want to ask this one since you brought up the scarring issues. Not necessarily the Fed, but just more broadly, are there policies that you think need to be in place to curb gender inequality and the disparities we're seeing? You mentioned parents, and we know parents have been affected more by COVID than not, but we were lagging on gender participation, women's participation in the labor market prior to the crisis, other major developed economies. And that's something that, for me, is really disturbing and hard. So what are your views on that in terms of, I know you mentioned scarring, but policies that you think would be helpful in that front?
Well, the growth of our economy is obviously critical to a bunch of things, including our fiscal situation, and our competitiveness internationally. As you know, and everybody knows, demographics are and are going to be a challenge. Fertility's down, immigration's down, workforce is aging. That doesn't mean that we have a slow growth destiny, but if you're not going to have a slow growth destiny, you've got to get people off the sidelines and into the workforce. You look at Japan, which has figured out a way to do that. It's not that it's undoable. One piece of that is a lot of what I talked about in my speech: training, mismatch, working on the people who are at the edges of the workforce, our policy. Another piece is the sectors like women and like seniors who have upside in terms of their workforce participation. You asked about women in particular. One really interesting thing to me is there was a whole period from, I'll call it the early 70s through about 2000, where women's participation seemed on an ever upward trend. Between 2000 and about 2017, it actually dropped about 4 points. At a time when in Canada, it actually increased 4 points. So it's pretty interesting to look into it. When we've dug into it, and I think it's also true right now, the biggest gap is lower middle class women, right? And I think when you sort of think about it that way, that means it's sort of not a societal norm thing. Mm-hmm. It's you've got people who've got real life situations, often primary earners and primary caregivers. You've got benefits cliff kind of issues, going over there. You've got childcare and the cost of childcare and the approachability of childcare. That's another set of issues. And I think thinking hard about that sector in particular is a pretty important one to work on. And so issues like childcare and elder care clearly make it. Earned income tax credit and how that's structured and how that's used is clearly the kind of thing you think about. I think gender-friendlier workplaces is another way to think about it. I've talked to a furniture manufacturer in West Virginia who's, you wouldn't think would be 60 or 70% women employees, but he's actually thought a lot about how do I make this place attractive. Even something simple like workplace childcare, which I've talked to a lot of employers, even some who used to have it and get really worried about the liability issues. And you sort of say, no, this ought to be something that could happen, right? There ought to be an economic model that makes this work. Why doesn't this happen at more scale? All of those things I think are relevant.
It's interesting, that last comment you made on childcare at work. I remember when it was much more common, actually, to see it in the workplace in the latter part of the 1990s. And I actually had a client who was competing for workers and happened to be, I had to overlay it for him, was in the midst of the opioid crisis and overdoses and things like that in a rural area. And one of the things I pointed out to him was the demographics of the area also had a lot of single mothers that were caught in a vicious cycle of poverty, and that he might be able to tip things And in a manufacturing plant, he did just that by having childcare. He had a more loyal workforce, and it broke the poverty for those women, and because they had a place they could go and have their children cared for, but also earn for them. So again, you're singing to the choir on that, Tom. So there's a lot of questions in here about the bond market and everything from the Fed's balance sheet. And, you said you guys will give us warning when you're going to taper because you don't want to get a repeat of the taper tantrum. So I'll let you comment on that, but also, what do you make of the recent rise in long-term bond yields? And do you see that as a threat to the sustainability of the recovery? And when would you see it as a threat to the sustainability of the recovery? So a lot of questions in there to let you go where you want on that.
Yeah, so on asset purchases, again, I think we've tried to be quite clear on outcome-based guidance. Right now, it's substantial further progress. I'll speak about what that means for me, which is December, we passed it. At the time, core PC inflation was 1.4, our target's 2. Employment to population, which is a metric I said I liked, was at 57.4. As of the end of February, it's 57.6. As of February 2020, I think it was 61.1. And so I don't think right now we're at substantial forward progress, but those are the kinds of metrics I'm going to be looking at. And, I'd want to get a good part of the way there before, having the conversation about whether we've made substantial forward progress. And then the chairman has said, we'll give advance notice. And so I think you should expect that as well. In terms of the bond market, obviously inflation expectations have been firming. That's a good thing, not a bad thing, so long as they don't get out of whack. And if you look at, market-based 10-year inflation expectations, they're about getting to our target now. If you look at the tips. So, that's been part of why yields have increased. The other thing that I, obviously note is that when you have good news about vaccines or you have good news about fiscal stimulus, yields seem to pop. And you ought to expect the market to adjust to news. So I think if what we've got is the market adjusting to news, that doesn't bother me. In fact, as the economy gets better, you'd expect yields to rise. Obviously, market functioning is a place we take very seriously, as we did last March. And if you start to see bid-ask spreads widen as we did last March, that's another conversation. But I don't know. I think the economy is in fact getting stronger, and I think the prospects for the economy are getting stronger. If you think about, what I said up front, excess savings, fiscal stimulus, vaccines, and pent-up demand from people like you and me who've been locked in our home for a year, I think there's going to be a stronger economy, and I would anticipate that that naturally should have an effect on yields.
So you're not as concerned, one of the things that, and I want to just dig a little further into this, and you mentioned it sort of in passing in your remarks too, is, is it a, disorderly, like we saw last March? I mean, you started out your comments laying out, I think people forgot. It's amazing people's memory on what happened last March. It was such a blur, but it was really disorderly financial market conditions that the Fed had to step in. It was worse than the onset of the great financial crisis. So in the Great Recession. So what would be disorderly to you? What the kinds of things that happened last March? What would be something that would pull the Fed back in and not just be sort of this natural progress that you're looking at?
I mean, it is hard to exactly define that, but I think, again, bid-ask spreads would be a good indicator of something not quite working the way it would. But I don't want to try to limit it. I'm sure there are other, versions of disorderly that I don't even want to wake up in the middle of the night dreaming about.
And wake up in the middle of the night having to deal with either, I'm sure. Yeah. It's the other side of this. What you've talked a lot about, and I'll let you close out because you raised the issue of scarring and inequality. And, many people have talked about the Fed disparagingly on inequality because of what the low rates have done to wealth inequality. On the flip side of it, what your goal is to get a more inclusive recovery by overshooting a bit on inflation and allowing labor markets to heal more fully this time around, which I think is noble. one of the other things people have offered some issues on is the regulatory issues that the Fed could do. Community Reinvestment Act, are there things the Fed can do? And I know you're on the ground and you are doing a lot, perhaps maybe that some people don't even know, but what more can the Fed do with regard to inequality when it comes to access to credit, given that you are a major regulator?
Yeah, so on the first point, as I've tried to puzzle this through in my head, here's how I've landed, which is we're at a time where there are 9.5 million more people unemployed than there were before. The notion that we would somehow today have higher rates to try to prick a stock market bubble and not use our full tools to help the 9.5 people, I don't quite get that argument. I mean, it's a very different argument, I think, if the economy's humming and you ask about, rates, but I just don't get that first part of the argument and I've heard it.
I know.
So that's the first thing. We do fair lending. We enforce CRA. We enforce, all those are things to help through our regulatory authority. Banks, participate in an equitable way in the lending market. I'll come back, I think, though, to our tools. We didn't invent fair lending and we didn't invent CRA. Congress did. And our job is to implement that on behalf of our legislators who invent that. And so I think we should be open to, where, those who lead our country want to take it in terms of those things. But I don't think the Fed should be making things up like that. We should be, implementing it. And so, those two things, I've seen them in action. They seem to be quite effective and, probably the mark of any good regulation, also quite appreciated, by people on all sides of the House. And if there were things like that out there, then that would be within our charter. But I don't know that I'd be making a new law on that.
So you'd be looking for Congress to rethink how you implement the regulatory changes as they come down.
Our tools are pretty straightforward. I think they're pretty effective, but they're pretty blunt instruments when it comes to inequality. Rates can go up or down, asset purchases, and we're charged with making sure we have a safe and sound banking system, subject to some constraints that have been given us by Congress. So that's I think what we're trying to do. We also have a very active, as community outreach and community engagement function. So we're very invested in research. In fact, the New York Fed published an article on the topic we started this question with recently. That was a very thought-provoking. And so you've got people out there trying to push the thinking, which then sometimes can land in legislation, which sometimes then can land in what we do.
Well, we're running out of time here, but Tom, this has been great. Thank you so much for your time and your support of NABE and your, willingness to even push back and answer with, I think we got a little more clarity on some stuff that I was pushing for because I was told I need to do this. And I also, I want to help to bridge this communication issue. And I really appreciate all that you're doing. So thank you.